Welcome everyone to another Port Jackson Securities webinar. Here we have Alex with Barton Gold, the CEO and Managing Director. Obviously, he's going to sort of go through what he's told me, a very big announcement for himself and the company, and he'll run you through obviously a few other details as well. But mainly with the webinar, you'll be able to sort of put any questions in the questions tab, which would be on your screen. They'll be answered at the end. And of course, this is only for information purposes only and does not constitute any investment advice as well. So we'll let Alex take it away, and yeah, questions in the questions box, and we'll get them answered at the end.
Great, thank you very much, and thank you everyone for joining us today. Hopefully everybody can see the presentation up on their screen. Before we jump into it, that image on the screen is not actually a it's not a stock image. That's actually a high-grade open pit asset that we have at our Tarcoola project, which I'll explain more in a little bit. Usual disclaimers. And look, just as a general introductory overview for anyone who's not already familiar with the story, the big picture for Barton Gold is that we are a South Australian focused gold developer. South Australia is a very interesting state. It is known as the state for production of uranium and copper in Australia. And it has a major historical focus on investment and development in the copper uranium space, but it also holds 25% of Australia's known gold resources. But that focus on the historical focus on copper and uranium production means that there's been very little investment in gold. Now we're in a very interesting area, which has got 3 major copper gold mines. And just across the highway, we've consolidated essentially the majority of all significant historical producing and exploration assets in an area of the Central Gawler Craton. In that area, we've put together just over 5,000 square kilometers in tenements. And on that tenement package, we have built now a 1.3 million ounce resource base. And the big news today is quite literally this morning, we announced that resource upgrade. So we added nearly 200,000 ounces of resource that we announced this morning, and everyone here is actually the first people hearing about it. In and amongst all this, we also own the only gold mill in the region, so that's a very strong point of leverage for us, both in terms of our own mineralization, but also in terms of the other explorers in the region. So there's a huge amount of upside here. There's a 130-year gold production history here, but it's been very underexplored from a modern contemporary standpoint. We are already growing resources at a very low cost per ounce, and we believe there's multi-million ounce discovery and development potential here. So we have a very simple and clear strategy focused on gold. We have an excellent leadership team, and we are also very well capitalized. We have about $8.3 million in cash. On the capital snapshot, we have a very tight share registry, so about 176 million shares on issue, and our current market price, it values us at around $40 million Australian in terms of market cap. And then subtracting cash of 8.3 million, we've got about a $32 million Australian, or 23, $24 million United States dollars enterprise value. And we have, importantly, very, very strong management and shareholder alignment. So board and management own about 1/3 of the business. In terms of our leadership, one thing that we like to focus on is really building up an excellent team that reflects our forward development ambitions. We are actually an advanced asset manager. We have brownfield assets, we have a mill, and we have a development mandate. So we built a board and a management team that really reflect that. And we've got a lot of experience in gold. We've got a lot of experience in South Australia. And collectively in the senior leadership team, we've got well over 200 years of experience in exploration, financing, development, operations, and project management of mining operations. So we're very well suited to moving this forward. Now, the big picture for us, what is that mandate? What is that objective? Our objective is to take this land package that we've put together and develop South Australia's largest gold producer, largest independent gold producer, in the next 5 years. So we're targeting to produce 150,000 ounces per annum of gold, and to be doing that on a running resources base of 2 million ounces gold or greater. And where we're really focused in the first instance is at our Tarcoola and our Tunkillia projects. And the reason is that this is large scale, open pitable style of mineralization where we've already got 1.2 million ounces of gold, on less than 2% of the known structures in these project areas. And open pit mineralization is cheaper, easier, and safer to find, develop, and operate. So it's lower risk, it's more profitable. And we have a staged development strategy here where we utilize our Tarcoola project and some high-grade mineralization that's there, and we're working on building that up to start a stage 1 operation using our existing mill. That gets us into operations cheaply and efficiently, and then allow us to move into stage 2 expansion. And that would be then moving down to Tunkillia, building a new open pit operation with a new mill, and then Tarcoola and Tunkillia will operate together in tandem with high-grade material from Tarcoola going through the new mill at Tunkillia. And that would open up our existing mill to then consolidate the region around it. Now, one of the reasons we're focused on this large-scale mineralization at Tunkillia is that it looks a lot like the Karlawinda project. And Karlawinda is a project that was developed by a group called Capricorn Metals. They are a group that has made time and time again, they've made the case for the preferable nature of large-scale open pit mining and gold mining. They bought an asset called Karlawinda. That looks a lot like our Tunkillia asset in many respects. They purchased that back in 2015 for about $20 million. It had about 650,000 ounces at that time. They grew that to 900,000 ounces, and then 1.1, 1.3, 1.5, and then they focused on studies for bulk efficient open pit mining operations. And fast forward a few years now, today they are processing 5 million ton per annum. It is a 2.3 million ounce resource at 0.7 gram per ton, but they're processing 5 million ton per annum at an ore grade or a head grade through the mill of 0.9 gram per ton, which may not sound like a lot in the scope of the traditional thinking about high grade underground mining, but they are today Australia's lowest cost gold only mine. So they're producing an ounce of gold for less than $1,200 Australian on an all-in basis. And that's equivalent to about $800 US on an all-in basis. So it's a phenomenally profitable model. And we are growing our Tunkillia project to emulate this larger scale, more profitable model. And as you'll see now as we move forward, we have already gone through these first 3 steps now. We acquired our resource, it was about 558,000 ounces. Then we grew it to 965,000 ounces, and we've now grown it to 1.15 million ounces. So we've really been building up quite a bit of momentum since we IPO'd. We've been bringing a lot of new technology into the region to basically accelerate it from where it was in sort of the 1990s status. We are leveraging our major asset platform, not only to generate capital that covers our corporate costs and preserves our cash and extends treasury, but it also reduces our in-field exploration and development costs. So we have significant camp and property holdings that mean we don't have these logistical costs when we are doing work in field. So we've had quite a bit of success since our IPO. We've already found 4 new gold zones. That's added over 2 kilometers of new gold mineralization. We have a lot of support from the South Australian government. They've given us nearly $1 million in grants since listing 21 months ago. Yeah. And we've generated $5.2 million in additional cash from non-dilutive asset monetization initiatives. And this is $5.2 million net of the cost of generating that cash. So that's a huge amount of value that we can generate and preserve for our shareholders that, of course, many of our exploration peers cannot because they don't actually have this asset package. We have, in that time, also done about 31,000 meters of drilling, about 14,000 of which were on the 223 deposit. And this is the big news for the day, is that the 223 deposit has just had an updated JORC mineral resource estimate. And so we have added 189,000 new ounces to that deposit. We've increased the tonnage of that deposit by about 12 million tons. So that's a 45% tonnage increase and about a 20% increase in the total gold inventory. And we did that, very importantly, at an all-in cost of around $12 per new ounce, and that's Australian dollars. So that is a phenomenally low cost and really gives us quite a bit of excitement to keep pursuing extensions of this deposit. When we look at Tunkillia itself, we'll start there as the sort of the big picture stage 2 perspective. Again, what we're looking at here is developing really large-scale bulk mineralization for long-term, large-scale operations. We have just updated the resource, as we just discussed. We have 3 new gold zones around that resource, and we have a very strong pipeline for continued extension, growth, and exploration in the immediate vicinity around that project. And importantly, what you can see here is we have about 50 kilometers of major shear zone systems surrounding and crossing our tenements. And these shear zones come together at essentially the conjunction of 3 distinct geological units. And that creates some really interesting opportunities for a lot of fluid movement and deposition here. And we're seeing that in the region and what we're doing. So when we zoom in on that main project area, we're looking in the northwest corner of our tenements. This is where we have that cornerstone 223 deposit. So this is 2 kilometers long. It now contains a 1.15 million ounce resource. So that's just on 38 million tons. And what we've demonstrated in the past 18 months is that while this deposit was known, the gold endowment around the deposit is much broader than has previously been recognized. So we found 3 new gold zones in that past 18 months. Those are 223 North, Area 191, and Area 51. And we've actually grown the 223 deposit itself twice since we've acquired it. And the interesting thing to understand about the 223 deposit is we've got about a 300,000 meter drilling database. 80% of that drilling was done between 1996 and 2005 when the US dollar gold price was below US $400 an ounce. So there is a very artificially restricted search domain if you think about it in the context of the current gold price, right? When the gold price is so low, you can only drill so deep, and capital allocation is going to be very limited. So we've grown this twice. The mineralization in the 223 deposit remains open to strike at a long depth, and we're targeting additional growth in that resource and regional discovery as we keep moving forward this year, next, and the year after. So when we jump into the 223 deposit now, this is a very useful cross-section that speaks to that sort of limited depth of historical drilling. So we've got a long section here which shows a couple of things. One, it shows a lot of the drilling that we did to extend these resources to depth. And it shows the base of the 2020 resource model shell and the base of our new 2023 resource shell. And what you can see is we've generated 50 to 150 meter depth extensions in our 3 key targets for growth that we had set out to target. And the cost of doing that has been very, very low. So we've invested a total of 2.3 million Australian dollars, which means we've generated these new ounces for an all-in cost of about $12 per ounce, or put another way, for the roughly 11,250 meters that we drilled, for every single one of those meters, we generated 16 ounces or 16 new ounces of gold, which is an extremely high payback. So that's very exciting for us. When we compare this with our prior resource estimate, we've actually been much more conservative in the way that it's modeled. So we've tightened up the wireframes. We've been more conservative, capping the grades in various domains, and adding internal dilution, or allowing more internal dilution in the model to emulate that broad bulk open pit style of operation that we see in our sort of development heroes, which are Capricorn metals. So very exciting in terms of the extensions. And then when you actually look at the characteristics of the deposit, we have a very interesting profile emerging. And that is one where within this deposit, we have a shallow supergene blanket, which is the light blue flatline profile you can see in the image on the left. And that contains 225,000 ounces of gold. So that is a blanket, an enriched blanket of mineralization that sits on top of the main deposit along strike. And it means that as we go down and start developing this asset, that blanket of mineralization will pay for us to open up the length of this deposit. And then as we start mining down, that's where you start producing, the dividend style material. But also in conjunction with that, we have identified in the center of the deposit here, and you can see the cross section on the right, a high grade core zone. So this is a zone that's about 300 meters long. And it shows you that what's typical of this deposit is having 40 to 80 meter aggregate mining widths, which is really amenable to bulk open pit mining. But here in this central zone, we also have this sort of interesting economic kicker where we have mining blocks or mining areas here where the grade is ranging up to 5 to 10 grams per ton. So again, you have the opportunity to develop this central deposit, the central portion of the deposit first, to open this deposit and then start opening up along strike, paid for by that supergene blanket. So that's very exciting from a potential development standpoint. And then when we step away from that deposit again, we have, as we noted, we found multiple new gold zones already. And what we're looking at on the left side of this screen is a cross-section of that Area 51 prospect we looked at. So this was the first significant step out, if you will, from our main 223 deposit. It's about 3.5 kilometers away to the northwest along the same shear zone. And we have now mapped out 700 meters of new mineralization there. Importantly, that also has a higher grade core. So there's a significant core in the center there that has 50 gram meter mineralization. So very attractive for open pit mining. That unfortunately was cut off at the western margin by a shear there. But what it tells us is there are more systems and repeating systems of mineralization here, and there is more potential for other bodies of mineralization with high grade cores. So Area 51 is really just the first step. Everything that we've looked at is in that yellow circle at the top of your screen on the right there. We have another 20 kilometers of shear zone that's essentially untouched. And we're going to start working down that now to see if we can find repeats of this big, broad mineralization, potentially with some interesting higher grade cores as well, because we would, while we would love to turn this into a 2 to 3 million ounce resource for a long-term operation, we would really, really love to continue to grow that and actually scale this operation to its true district scale potential over time. And then thinking about our other asset, Tarcoola, if you're going to have really large-scale bulk open pit mineralization, what you would love to have is some high-grade mineralization nearby that you can blend into that low-grade feed and average up your average feed grade. And the reason is that's all going to be pure cream in an operation, pure additional profit. So now we look up at the Tarcoola project, and we are located only 70 kilometers north of Tunkillia, so about 45 miles. So Tarcoola is really actually just a satellite to the long-term Tunkillia focus. But Tarcoola is interesting because it was the site of South Australia's original gold rush. So on our mining lease, 6455, which you can see labeled there in the middle of this image on your screen, that was where the old timers, starting back in the late 1800s, they mined about 77,000 ounces of gold by hand, just from shallow veins sticking out near surface. Now, that's not an enormous number of ounces, but the grade was over 1 ounce per ton. So that's very, very attractive. And this mining lease, this was turned into a mining lease about, sort of in the 2010s. And during 2017 and 2018, there was an open pit there that was producing ore going to our mill. So during 2018, that open pit sent about 3.8 gram per ton ore to our mill, which is very, very high grade for an open pit. And we think there are potential to find repeats of those open pits and that mineralization, both on the mining lease, but also as we move along a very long list of targets we have there in our Western Targets area. So we are actively mapping out these targets for additional drilling during 2023 to keep building up this side of the story as well. And the idea here is that the combination of this mining lease and our fully permitted mill gives us a simpler, lower cost path to stage 1 production. So while we may be targeting 150,000 ounces in 5 years, we want to use this current mine and our current mill to start stage 1 operations much sooner, generate free cash flow, and then fund our expansion to stage 2. So when we look at that open pit itself, this is really useful to understand what that style of mineralization is and what we're dealing with. As you can see here, and as you might have noticed on the cover of the presentation, the pit itself was only developed to a very shallow depth. So it was developed to about 30 meters deep in the north and about 70 meters deep in the south. Now, we have drilled below and along strike of this pit, and we've mapped significant extensions of mineralization to depth over 200 meters below the current pit floor. But we also found an entirely new high-grade zone sitting just behind the southern wall of the pit. So that's quite exciting because that pit doesn't need any pre-strip work to go into it and just start mining. And when we look across the mining lease and our nearby target areas, what we're looking at on this slide here is an image the size of the mining lease. We've identified 3 areas that we think may host mineralization. That's sort of a repeat of the style of that high-grade pit. But as we look on the image of the right, we have now mapped many of the structures in the region. And what we can see is we have some major intrusive bodies that are meeting major deep tapping structures that create fluid pathways. And the Perseverance mine sits on top of the Perseverance shear. So we can see through the combination of that shear and this intrusive body that brought a source of heat and pressure and fluid to push up through the mineralizing formations and create that gold deposit. We can see what the genesis of that is. But what is more interesting is as we look across the 10 kilometers to the west, we have a series of repeating and lookalike shears and structures that were not previously recognized. Now, looking all the way to the west, we have a project there called Warburton. And in 1997, AngloGold drilled a hole there based on geochemical signature. And they drilled a 16-meter intercept at 3.4 grams per ton, essentially from surface, which is very exciting. But in September of 1997, the US dollar gold price was $300 and falling. So they didn't follow that up. But in the west, we have Warburton. In the east, we have the Perseverance mine. And lo and behold, with this structural interpretation, we can now see that lookalike structures that pass through the same Tarcoola formation, that mineralizing basin, and plumb into exactly the same intrusive bodies, providing heat, pressure, and fluid. There is a structure that comes up right below that Warburton target. So that really explains the context of that drilling intercept. And then when we look between Warburton and Perseverance, we have essentially a buffet of areas where, again, we had known interesting targets, but nobody had the structural context. And we can see there are multiple structures that come up and point directly at these targets. So we're quite excited about Tarcoola. It's sort of early days on the drilling side, but we believe we may have a cluster of potential high-grade bodies of mineralization on the mining lease. And then as we look west of the mining lease, we may have a cluster of clusters. So for us, it's been very, very busy building up this story. Obviously, a lot of work has gone into the current resource update. This year, we're going to be following all this up with additional drilling at the Tunkillia project, both on that 223 deposit and in our regional growth targets. We're also going to be going out. We've been doing a huge amount of regional review on Tarcoola, looking at structures. We're going to be doing some additional seismic work to firm up our understanding of the structures. And then we're going to be drilling across our mining lease and those Western discovery targets. The objective is to actually come to the end of the year and do further mineral resource updates. So, we can crystallize the understanding that both the pathway to stage 1 and stage 2 development operations. Another fun thing is that for those of you who may follow our news, you may have noticed in December of this year past, we did a partial mill workover. We took about 10 tons of concentrates out of our gravity circuit there. And we actually previously sold about $1.5 million worth of gold recovered from our gold room. This has come out of the circuit that feeds into the gold room. So we don't know what it grades yet, but we expect that we'll be making some additional gold sales during the balance of 2023. So another example of one of those ways that we are generating cash from our assets to reduce shareholder dilution, and by preserving treasury and minimizing capital that needs to be raised externally. And then going into 2024, we're going to continue growing these assets, and importantly, we're going to start thinking about how we actually develop them. So, for those of you who are new to the story, or those of you who are watching it and seeing this sort of steady progress we're making, we really have a pretty interesting platform. We have a fully permitted stage 1 infrastructure and mining leases in place. We are de-risking these assets for a stage 1 restart. We're growing our bigger picture quite rapidly, both in terms of the project footprints and now in terms of mineralization. We are targeting long-term, low-cost bulk operations. We're very well capitalized to do this. We have an excellent team with a lot of experience, and we've got strong stakeholder support. And of course, as we have for the past 18 months, and as we will be for the next 18 months, we've been very, very busy. There are multiple catalysts and milestones to come, and of course, very consistent progress on all fronts. So we'd be honored to have your support, and I will be happy to answer any questions that you may have.
Thank you, Alex. That was obviously very, very educational. Obviously, a very good presentation as well. I had about 5 questions I was going to ask for the viewers as well, but you've gone through everything I was going to ask. But there is one question that I do have in mind. Obviously, typically as gold is used for a hedge against fluctuations in the stock market, etc., etc. With the price of gold where it is at the moment, how do you think that would affect your company moving forward?
Well, we were very happy to own these assets when the gold price was $1,500. The gold price being where it is right now, I would say it just makes it more exciting, right? Mining is one of those things where once you establish your cost of operation, any upside fluctuation is essentially pure profit. Yeah. And conversely, that's why it's really important to have assets that are very defensible. So, these assets we believe will be able to produce very efficiently and conservatively on a bulk open pit style method. That's why we're focused on this style of mineralization. So look, we're very interested about where the gold price is now. It's always a little bit dangerous to speculate about where it will be, but my economics background has a habit of coming flying out in these types of discussions, and we've been tracking the gold investment thesis for a very long time. We actually started buying all these assets, started working to buy all these assets over 6 years ago on precisely the gold investment thesis, in the scope of evolving sovereign risk, credit risk, and then basically security risk, and it's coming true. And I think 2023 will be a very interesting year ahead for the gold market.
Yeah, I think that's a good way of looking at things. And I mean, let's say the gold price does drop in value. Do you think that will impact the company moving forward, or is it because you've got things set in place you're trying to avoid that?
Yeah, look, so just for perspective, we have an unusual advantage in terms of moving forward in that we already have a fully built mill. As a rough estimate, if you were going to try to build a new mill in this area from scratch today, you would have 2 to 3 years of engineering studies and permitting. And by the time you built it, you'd have spent $150 million.
Right.
So
you've got that obviously.
Turn on an existing mill. Yeah, it means that we don't need, when we think about our mineralization, we don't need to think about how we're going to pay back the bank on that mill. Okay. And so we can take, we could take a very substantial decrease in the gold price without the operation becoming uneconomic. Now, we would prefer to save those ounces for a stronger market. But that is one thing. Our infrastructure makes these assets very defensible from an operational standpoint, and our break-even gold price is much, 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 much lower than our peers who still need to actually build and build.
Okay, right. And just for anyone watching and anyone out there, if there is any questions you have, just type them in that question box, and I'm sure Alex, like you said, he's more than happy to answer. And obviously, the other thing I noticed, obviously, you focused in South Australia. Is there any expansions outside of that area in the future, potentially, do you think?
Well, look, we are opportunistic acquirers of economics, right? So we're pretty disciplined in how we look at things. We do a lot of evaluation on every drill hole we drill, and then we do a lot of evaluation in terms of what's happening in the market and what's happening, around us. What I would say is, we see the opportunity in South Australia is excessively attractive because of how underinvested it's been. It would always make the most sense for us to acquire assets in South Australia because we have, efficiencies of proximity here. But that doesn't rule out us making an opportunistic acquisition if we spot the opportunity to grab some real value and also accelerate that. But we could probably spend $500 million and 15 years consolidating South Australia and never run out of interesting things to do. Especially on our own ground.
Yeah.
We think that we're likely to go and find all the things that someone else would want to do.
Yeah, of course. Well, I think obviously the fact that you've got everything in place, the expenses mightn't be as high as many other gold companies out there. So you've got that advantage, like you said, which is quite attractive for shareholders. I know you mentioned a little bit about dividends. Is that something that you're looking to continue giving to your shareholders?
Well, so we're not paying a dividend at the moment, right? We are a net spender of capital. So our job is to invest into the ground so that we can bring that capital out of the ground with a significant multiple return. But the idea is that when you think about the way that the operations would be developed, so I'm just going back to the map here. When you think about the way we would develop this, the idea of the stage 1 development is that this generates free cash to pay for the stage 2 expansion, and therefore not only bring us to a point where we have large scale production and we could pay a dividend, but very importantly, and this is why we focus so much on monetizing our assets, is the traditional pathway forward is doing many successive and very large and very dilutive capital raisings. If we can start our stage 1 operations without raising $150 million in equity, and if we can start our stage 2 operations without raising another $150 million in equity, our shareholders today are going to own much, much more of that company than they would with many of our peers who need to spend $300 to $500 million before they could even whisper the word operations.
Yeah, I do agree with that, which is obviously again a big advantage for yourself and shareholders. Well, look, thank you for the presentation. It's been very, very, very educational and informative. And again, everyone watching, thanks for joining, and we'll see you at the next Port Jackson Securities webinar. I'm Harry McCaskill, and thank you, Alex.
Thank you very much.
No worries.